What are investors to make of this market right now? Patrick Schaffer is a global investment specialist at JPMorgan Private Bank. Joins us now to discuss. So I guess let's kind of start 30,000-foot view. What do you make of the environment right now? Today's action a little bit weird, but basically at record highs, pretty much overlooking every negative headline that comes our way, and everything seems fine.
Yeah, you're absolutely right. Markets have been impervious to a lot of issues. And if you just think about this calendar year alone with impeachment trials and Middle Eastern tensions and Brexit finally happened and earnings and coronavirus, et cetera. And here we are right now, and we're within 0.5% of an all-time high in the S&P 500. And the market dropped 1% today, and everybody was trying to figure out what the heck happened. And it really wasn't anything other than just, honestly, it's a very natural consolidation of what happened over the last week.
But Patrick, so if you're a global macro kind of guy, I guess, right, then what do you like? And it's hard, because there's only one game in town, and that's America. And you see people trying EM, and that didn't work out too well. It usually lasts like 6 months. So what about you?
I think there are a lot of things to do. And I think from, as you said, from a macro perspective, I think you still have to favor the U.S. You still have to favor stocks over bonds. Given the valuation environment that we've been in, I'd say right now, certainly over the last, call it 60, 75 days or so, the multiple expansion that we've seen right now, one of the big debates is we just seem to be in a war of multiples. What is an appropriate multiple to pay right now? And from a historical context, everybody loves to say, oh, wow, with the market trading at 19.5 times versus a 16.5 times historical multiple, isn't that expensive? Well, I think you need some current context for that as well. And we need to think through where interest rates are today, with the 10-year really staying stubbornly low at about 155 right now, and that's down from around 190 to start the year. Inflation nowhere to be found. From a current context perspective right now, valuations are supported. Go ahead.
Oh, no, what did we just talking about a little bit more granular here on companies, and you've listened to a lot of earnings calls, you said, and that you've learned that management sentiment seems to be strong and improving, but that it's really not that simple. Are you as optimistic as a lot of these companies are that you've been hearing from?
It's interesting. When we go back and we look at fourth quarter earnings season and we think through and digest what was coming from management teams during January earnings calls, a lot of that may already be stale. It's really important to think through the impact that coronavirus is going to have on first quarter earnings. Now, that also provides a really easy cover. And when you think about that, it's such a convenient thing to talk about, oh, well, we have X% of our sales in China, and that really slowed down. And by the way, that's true,
yep.
But it's going to be a very natural cover. And it's also going to be the sort of thing that when earnings estimates for this calendar year bleed lower, so coming into the year, earnings estimates for the S&P 500 were around 174, 175. That's likely to drift a little bit lower on coronavirus. Dollar strength may cause that to drift a little bit lower. Also, it provides a really easy cover for people to just say, this is ephemeral, let's look through it, let's start looking into next year.
And then I guess the other part of this market is, isn't it all about the Fed and what might change that?
I knew he was going to ask.
Well, I mean,
he's a Fed dog.
Because it kind of is. And I guess the question is, what would change that, given that the Fed has said they are probably not going to be raising rates anytime soon? I mean, is it going to be some surprise hawkishness from the BOJ that all of a sudden, now we're BOJ experts or something like that?
No, Miles, I don't think so. And yes, I think you're right. If you look back to last year, over 40 central banks cut interest rates over 80 times. You can't overstate the impact that had on markets last year. And when we sit here today and we think about the Fed, one of the hallmarks of this current environment is there is less uncertainty around policy rates right now. Yeah. And that less uncertainty allows investors to be more comfortable that interest rates are low for now. There's likely not going to be any action, at least out of the Fed, for the time being, and that provides comfort.
And I just want to go back to something you said about valuations, because they are elevated right now, but we all can do the math on the discount rate, so it really shouldn't be all that high. But certainly, you sit in a lot of meetings, and clients say, valuations, crazy. They have to go lower. And I mean, how do you kind of respond to that? Because I think it's such a common critique of this market, and yet that critique has mostly ended up in people being underinvested.
Miles, people have been having this conversation for the last 5 years. honestly, and it's one of those things that just is a really.
That's all he knows.
From a valuation perspective, people still feel snake bit from what happened during the
2008
during the recession.
Yeah. Oh, okay.
11 years ago. Now people still feel the impact of that, and this valuation framework is something that has caused a lot of people a lot of opportunity cost and to not be invested. I think it's really important to maintain a long-term mindset on that.
It's interesting, Patrick, when you say that, because how long do these things stay with you? Because as far as with the Great Depression went, the 1930s mentality stuck with that generation their entire lives.
Well, till they die.
Till they die.
Or maybe if you're still
many of them are alive.
Yes.
Right.
So,
yeah, I mean, like we're very frugal and all that. Yeah. And so it's interesting to talk about this behavior, just in terms of markets, for instance, lasting. We say, that's a long time. Well, maybe it's not that long.
Those scars from events like that tend to last a lot longer than people kind of think they should.
Yeah.
It's a behavioral finance thing. It's something that people need to be cognizant of, that sort of a bias when it comes to it. And if you think through things in very long periods of time, things should still be fine. And one of the things you asked is, like, what do we tell people? Yeah. I tell people to moderate their return expectations. You need to lower your return expectations today versus where they were even 3 and 4 years ago, but to still expect positive long-term returns. And through that lens, you can help get families and investors putting money to work.
Yep. All right, Patrick Schaffer, Global Investment Specialist at JP Morgan Private Bank. Thanks so much for coming on.
Thanks.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.